Hi everyone, it's Alex here at Sestream Capital Research. Welcome to our Growth Investor Pro weekly webinar for Thursday, the 6th of March, just after 4:15 Eastern for the benefit of the tape. Okay, so market's obviously pretty volatile right now. I thought we could cover the equity indices, so look at the S&P, the Nasdaq, and the Dow, a couple of sectors, semiconductor and software, and then a fair few single name stocks to get through. Let's start off with a couple that were actually in the green today, which is Zscaler and Veeva Systems software companies. And then we'll dive into semiconductor and a couple of Mag 7 as well. As always, we run on a live and open mic basis. So if you have any questions, comments, points, anything at all, anything you agree with, disagree with, just open your mic and shout into the system. Failing that, you can use the question or the comment function here in the webinar platform. So in a moment, I'll do our disclaimers. And then after that, we'll switch mics on and we'll get going. So get a disclaimer on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not intended or directed towards UK recipients. Any information or analysis on the webinar is not an offer to sell or solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestream Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestream Capital Research. Sestream Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get microphones on. Okay, mics are on, and let's get going. So let's start with the S&P. Okay, so this is the short-term or shorter-term S&P chart. Okay, so this is a daily chart, and it starts at the August lows last year. And so far, we've had a wave one up into the end of August, a two down into the September lows, a run up all the way into the middle of February, which made what's so far a wave three high, and may prove to be a wave three high. I don't know, but so far a wave three high at around 614. A fairly shallow wave three between the 1.236 and the 1.618 extension, and we have now what is possibly a step down as part of a longer wave three, or I suspect more likely what is shown here, which is that was a wave three high, and this is on the way to being a wave four low. Why do I think that? Well, because it doesn't take to get much lower, 565, to hit that wave one high, and also because it's been, as we can see, a fairly concerted sort of sell-off in recent weeks. Now, the key levels on here started including these moving averages, because when stocks decline, it's pretty useful to see where the potential support might come in. The light blue line is a 50-day moving average, which is that tends to hug price fairly quickly. And it's not uncommon for a stock to fall below its 50-day. You can see it. I did it here in August, did it again in September, again in December, all apart as a strong bull market. So a breach of the 50-day isn't nothing, but it's not something of earth-shaking magnitude. What matters a lot more is the 200-day, and that's the thick purple line you see on the screen there. Why? Well, because it's a convention. The convention says that stocks that are over their 200-day are basically in a bullish setup, and stocks that are below their 200-day are basically in a bearish setup. And it's just convention. It's nothing other than convention. But because it's convention, investors respond to it. So you'll see, this is the last 3 days of SPY. You can see that the 200-day was hit on Tuesday, Wednesday, and today. And it's actually breached intraday today. But so far on the close, it's held up. And due to Avago numbers, Broadcom numbers, the S&P is up a couple of points just now in the aftermarket. We'll see if that holds. So right now you would say there's a chance that the selling is done. Why might the selling be done? Well, because although people pin the reason for sales on something they find in the news, so you could say, well, it's flip-flopping around tariff policy. That's what's causing the sell-off, or it's fears about job numbers tomorrow, or it's concern that there's going to be harm to the economy from I don't know. You fill a number in: egg prices, federal layoffs, I don't know, something. It's possible it's all those things, but more likely is that there's some selling, there's some momentum has gotten into the selling, and the question is, can the selling be pushed below the 200-day? Why? Well, if you're a market maker and you make money basically on trading, for want of a better word, then bouncing the S&P or anything else around between the 50-day and the 200-day, that's just the day job. What can get really interesting is if enough order flow comes in from actual investors to say, okay, start selling below the 200-day, start lightening exposure below the 200-day, and then that can attract an avalanche of selling, because selling begets selling, just as buying begets buying. So this level here is really important. It's 572 on the SPY, and if that breaks, and it may well do, then I would expect some probably significant downside ahead. Let's look at the QQQ. It's exactly the same argument. Now you can see that the NASDAQ has broken the 200-day. Okay, it broke it on Tuesday, intraday, yesterday, intraday, and today, and it's closed below it today. So that's not a good look for the NASDAQ. It really isn't. Now, it's at 490 right now with the Broadcom numbers, which again is still below the 200-day. So this could be a sort of a head fake down. But if the NASDAQ doesn't reverse up again pretty soon, then again, I think we're going to see some a significant amount of selling. Now, not coincidentally, this 200-day also ties into this prior wave one high here. You hear me say often that there's lots of different technical methods that work, and the reason they work is they're all sort of measuring the same thing. And so when you get coincidences like, well, how come the 200-day is the same as the wave one high? That's because they're all driven in essence by the psychology of buying and selling. And so it's not really surprising that these indicators tend to align more often than not. So the NASDAQ is looking particularly weak. And then the Dow is a long way above its 200-day. It closed on the DIA today at 426 just about. And the 200-day is at 419. So there's a fair bit to fall yet. The Dow has held this low for 3 days now. Held it on Tuesday, Wednesday, Thursday at 424 on the DIA. And if you look at the Russell, look at the Russell much here because it's got its own challenges. But the Russell did the same thing. It held the line the last 3 days. And very often when you see that, when you see the Russell and the Dow look like they're holding support, you can see an upturn first in the Russell and the Dow, and then in the S&P and the NASDAQ. So I'm not saying that it's all going to be sunny and bright tomorrow. Obviously, no one knows. But there is the technical possibility that we see a reversal to the upside tomorrow. Why? One, because the 200-day in the S&P was not breached at today's close. It was breached intraday, but that's not such a big deal. But it wasn't breached at the close. And also because the Dow and the Russell have sort of held this low here, Tuesday, Wednesday, Thursday this week, and therefore perhaps there's no selling orders below this level right now, and therefore perhaps they can move up again. So if you're learning or you're already a master of the hedge method, then this is a great time to trade. So personally, I had a really good day yesterday. If you watch trade alerts there, and in addition to the ones posted here, I trade SOXL and SOXS, which you'll see in that inner circle service. Today, not so good for me. I was away from the screen most of the day. I contemplated hedging at the close yesterday, decided it was too close to a potential bottom. If it moves up, I thought it would rip up, and so I did not hedge, and I was not at my screen for most of the day. And by the time I got to the screen, it was too late to do so, which is a shame because there would have been some free money available from those short hedges. So hopefully, if you're learning that method, you're learning to take free money from the market when it offers you. Once again, the method today would have been very simple. hedge at yesterday's close. So if you own QQQ, buy an equal dollar amount of PSQ, for instance. That's the one-to-one inverse NASDAQ ETF. And then at some point during the sell-off today, if you were brave, towards the end of the day, then you could either hold the hedges in place, and you've got some unrealized gains in the PSQ. Your QQQ will be down, but you'll have some unrealized gains in the PSQ. And you could either sell PSQ, take those gains and cash them, or take the gains and use the profit, not the capital, but the profit, to buy additional QQQ amounts. Rinse and repeat. So it's a really good method, that hedge trading method. And if you have the appetite to learn how to do it, it means that when markets like this hit, this is a great environment to be able to do this, because when other people are squealing because their accounts are dropping, your account will be static, but you'll be generating unrealized and then realized gains on the short side, which is free money. It's like a dividend from the market that you can use to reinvest on the long side. Or in a bear market, a true bear market, the opposite, right? So you'll hold the short side as the dominant leg. You'll have the long side for counter trend rallies. You can sell those rips and use the free money generated by the long rip to add to more short positions. So it truly is a market neutral way to invest and trade. So hopefully you're starting to learn that. Okay, I want to look at two sector ETFs, and then we'll stop and take some questions. So SOXX is potentially at a low. Again, it's up a couple of points because of Broadcom. So this is the August low, October high, very, very, very deep retrace, right? So below the 88.6 retrace. The low so far was struck on Tuesday. Nice move up yesterday, sell off again today, but it did not make a new low this week. So we'll see if that's a low or not. You can see it's below the 50-day, that's the light blue, and below the 200-day, that's the purple. So if SOXX starts moving up again, the first thing you want to see is you want to see it up and over that 50-day and turn that into support. And I'd say the jury's out at the moment. We'll have a look at the Broadcom numbers later, publish a note, but so far I haven't seen them. If we just take a brief look at the reaction while we're on it. Okay, so it's not stellar. Okay, so that's good, but not dramatic. Okay, so we'll see. Okay, and then lastly, let's do IGV software. Now again, not coincidentally, IGV is sat right at the 200-day here. It did not make a new low today, so the low of the week was Tuesday, move up yesterday, sell off today, and it sat right at the 200-day. It's moved up and up over it, so it's 93.60. So it's possible, it's just possible that that's at support. And here's another thing, here's the August low. So if you want to look at it from a wave perspective, and again, it's very often the case that these things coincide. So that's your trade point 0, wave 1 high. You've got so far a wave 2 low at the 50% retracement, and let's see if it moves up from there. So it's possible that IGV has bottomed. The key, I think, to watch is the S&P. The S&P will lead. And so if the S&P can hold over its 200-day and move up, then there's a good chance we have a bull run then. If it breaks the 200-day and closes below the 200-day tomorrow, then look at more selling to come across all long equities, I think. Okay, should we stop and take some questions on index and sectors before we dive into the single name stock? So anyone have a question, folks? Richard, you're on. Hey, Richard, you're on. Okay, I think Richard might be on mute, in which case, Preston, do you want to go?
Okay. Sure. Yeah. Hey, thanks, Alex. One of the charts you showed there, might have been the NASDAQ, is quite close on the short term, I think, to tagging its wave one up from August. You mentioned, I think at one point, if it hangs out much longer below that 200-day, you could see a bunch more selling. I guess my question is, what happens if that bunch more selling happens? It breaks the wave one high. Does that invalidate this chart? And then,
Yes,
like,
it
where
would.
where are we at that point, I
It
guess?
would mean that that was a wave three, that was a wave four, that was a wave five, which is slightly higher, and it
Okay.
would then put us in probably something like an a B, a C correction, much more bearish
Okay.
as you can see.
Got it.
Um,
So it would adjust that way. Okay, that's helpful.
yeah, so
Thank you.
it actually it's a good spot. So it hit the wave one high today, pretty much to the dollar.
Hmm.
So that's a definite possibility, an ABC correction, definite possibility. To add to that argument, if you look at if you just look at the calendar, um, my sort of backstop for where the selling might stop. I mean, it might stop here, of course, but if it doesn't, I would think that March options expiry, which is the 21st of March, is pretty put heavy now. As in, I would have thought that you would have lots and lots of investors buying puts, and that means that typically there's a good chance for a bullish reversal there. Again, just to rehearse the logic of that. Why is that? So when market, if as an investor you buy a put, you have to buy it from someone. Typically you'll buy it from a market maker, an option dealer. So if you buy a put, that's a bearish thing to do. For you to buy a put, the dealer has to sell a put. So if you buying a put is bearish, them selling a put is bullish. Um, they have to maintain a so-called delta neutral book. In other words, whatever happens to the market, to the stock, the value of their book can't move. That's how they do business. They make money on the trading spreads, not on taking a position. So when options expiry comes along, one side of their book, all the puts they've sold, will expire. Either they'll be in the money or out of the money, doesn't really matter, but they'll expire, and therefore they'll have an unbalanced book. They'll own a number of um, uh, bearish. I'm sorry, hang on. So they've sold puts, which is a bullish thing to do. Um, the puts will expire, and they'll have hedged the selling of puts by shorting the market, either by futures or the actual stock, in order to have a delta neutral book going into options expiry. When the puts expire, when their bullish thing they've done, they've sold the puts, that expires. The bearish thing they've done to hedge it, which is to say short the underlying stock or short futures, they then have to reverse those hedges. So you'll see me refer to things like use words like re-hedging flows. So the rebalancing of dealer books around quarter end, if it's a put heavy quarter, is typically a bullish reversal. So if we see continued selling, then I would look to 21st of March or there and thereabouts to see some reversal to the upside. Now again, it could be that we hit March 21 here, and all we get is a counter trend rally like that, and then another leg down. And the way to deal with this is, my own opinion is, simplify your portfolio. The fewer positions you have, the easier it is to manage. And if you can learn how to do this hedge trading, then these sorts of markets should hold no fear for you. So, personally, you saw all the disclosures. I sold everything, all equities in my long-term portfolio except Intel, and I own some US government bond funds in there as well. That's it. I'm about two-thirds in cash in those long-term accounts. And then in my trading account, I'm just hedging long, short, long, short, long, short, and trying to make some money on the way there. Dominant leg I have in the trading account is long, and I'm trying to use the short positions to scalp short gains to generate that free money to roll back into the long side, because I don't personally believe the bull market is done yet. If the bull market is done, well, then I'll trim down my long positions in that account, and I've been doing that a little bit with TQQQ. But these markets are very navigable, if you learn to manage risk in that way. Okay.
Well, thanks. I guess one of the possibilities, if the if the A is in, say, today, could see a counter trend
Yeah,
tomorrow,
yeah,
and then go back into the March 19th
yeah,
OPEX at the C
yeah, yeah, for sure,
bottom.
for sure. Yeah, I mean, I wouldn't underestimate that Q1 OPEX. You know, in really brutal markets, it's acted as a big reversal. March, so Q1 2009, great financial crisis, it was a big reversal in Q1. 2020 COVID crisis, big reversal in Q1. So, you know, I wouldn't, if we see continued selling, you'll see people losing their minds. Okay, but
Hmm.
I think if we see that, then I would look to that Q1 expiry as a potential reversal point.
Right. Thanks.
Uh, Thanks, Richard. How's the audio?
Can you hear me now?
I can. Yeah, how you doing?
Oh, sorry about that. I
No, it's
guess
okay.
it was connected to the Mac. Apologies. So, yeah, my question was very similar, I think, and I was just going to ask if the charts show, almost perfect correlations between some, for example, wave fours, or in this particular case, the one you've got up right now, as if the wave five may have in fact completed and we're now
Yep.
in a correction. If the charts break as a result of these, let's say, external forces, because if all being well, everything would have just gone according to plan, and
Yep.
some of the semi stocks that were in a wave four would have progressed up to the wave five. But in fact, if external forces causes that to break, do we then just begin the chart at the end of the correction? We just wait, and then we're looking at beginning the charts again at the end of the correction?
I think so, because you have to look at this one of two ways, right? Either everything that's happening in the world right now is a brand new thing that securities markets have never encountered ever, and no technical analysis works because every situation is bespoke. That's possibility A. Right, so that might be true, but more than likely, it's not true. More than likely, you know, uncertainty around trade policy is not a new thing. You know, it's happened before. Um, you know, more than likely, uncertainty about federal budgets is not a new thing. It's happened before. So I think that although when one is in the thick of any particular changing environment, and for or against this administration, one thing you can say for sure is it's conducting itself in a very different way to most other administrations. When you're in a changed environment, it always feels like, well, this is a whole new thing. This has never happened before. And again, you could view that as good or bad, but uh, nothing's new under the sun. There's only so many levers that government have. And markets are well used to digesting all of these things. So my own view is that the technical analysis remains supreme, and it would interest me if that was a 3, 4, and a 5, because it's such a short 4 and a short 5, and it would tell me that, well, perhaps the environment we're in is that because there is policy volatility, what's going to follow is price volatility, and perhaps we have to be a bit more nimble when it comes to calling wave tops, and perhaps they are going to expire before a typical level. But I continue to think that markets react to government decisions all the time, since the dawn of markets. So I think the systems here will still work. I think that the psychological impact on investors for instance, the sort of flip flop on tariffs is going to cause more emotion in some traders and investors' minds, and that's going to show up in price action. But I remain of the view that it's primarily a psychological function, and therefore, given that all technical analysis really does is measure psychology, I still think that this will work. But yeah, if this is that was a wave 5, then yes, I think we're in an ABC correction, and yes, I would expect it to move higher whenever the C ends. Um, in the end, all governments need markets in good shape, and so even if this thing carries on selling off, you want a nice run up into the midterms. And the midterms will be upon us before we know it, and campaigning for the midterms will start very soon. And so even if what we're going to get here is a reset and a platform to then run up into the midterms, most governments want healthy equity markets and healthy bond markets. So my guess is, I know there was a presidential tweet today to say he's not even looking at the stock market. That might be true. It wasn't true of his last presidency, but I suspect that this stuff is weighing on them quite heavily because midterms coming up. So yes, I would. Long answer, but I would keep following the charts personally. Paloma, you're on.
Yep. Hi, Alex. Hi, good evening. How are you?
Good, thank you. How you doing?
Very good, thank you. Well, very good. Not so well, but anyway, I'm long the I'm still long my SOXX
Yeah.
and haven't hedged because I can't do futures. So I'm very actually the Broadcom numbers came out. The stock is up 9% after market.
Okay, that's good.
And, yeah, stock is plus 9%. But you saw the Nvidia action today, which was pretty scary. I'm just worried about this position. I don't know whether I should just reduce it, cut it completely, because it's concerning me. I mean, I don't know where semis are going to go. You have the CHIPS Act that Trump is saying all kinds of things about it as well, which is creating noise. And it's just a sector that concerns me in general.
Yeah, I mean, you're an inner circle member, so you'll see my disclosure on SOXL, which I've been slimming that down. So I've been cashing some profits on the short side, and then selling some units on the long side, on which I'm taking a small loss. But I figure that'll just be a tax shield in the end, just to reduce a bit of exposure. There's been my take on it, because it is uncertain. Technically, you look at these charts and you would say that is SOXX. That remains a potential bullish reversal down there. Perhaps Broadcom numbers kicks it off. If you look at SMH, same. SMH looks better actually. SMH doesn't look bad at all. More Nvidia in that, if I recall correctly. Let's have a look. Yeah, SMH looks a bit better. Technically, you can say that there's upside from here, but we haven't done the numbers yet. But Marvell printed last night. It's down 18, 20 points today, something like that. So that's not all that encouraging. So my answer has been, well, I'll make some money on the short side. I'll cash some gains with that, and I'll take some hits on the long side, but just reduce exposure. So that's what I'm doing. I've still got a pretty sizable exposure. And we'll see. The chart says this should go up, but but my own view is, well, I was too hasty to build too big a position, and so I'll just trade my way out of it. Long short, trade my way out of it. That's my approach with
it. Okay, thank you.
All right, thank you. Gleb, you're on. Welcome.
Hi, Alex. Good evening.
Hey, good evening.
So my question is regarding the hedging you were just talking about.
Yeah.
And you said that yesterday at the close you decided against the hedge. And
yes.
So basically, what were you looking at, and what made you decide against it? And also, just in general, what should we be looking for, when we decide on when we make these decisions, let's say for the S&P and the Nasdaq?
Okay, so this is what I should have done yesterday. It's always good to look at these things in hindsight. I should have said, okay, well, look, you were at the screen all day, because I don't trade live all day. I don't have time, business to run and so on. So I should have said yesterday, okay, well, you were at the screen most of the day, and you had a very good time, cashing short gains 2 or 3 times over, rolling into the long side, free money from the market. That's great. And it was a strong run up to the close yesterday, weakened into the close and weakened more after the close. And what I should have done is gone, okay, well, look, that wasn't a great close, and I'm busy all day today. And so if something goes wrong in the market, I won't be around to catch it. So therefore, hedge. Now, then what I should have done was said, well, there again, we're a bit close to the 200-day and the NASDAQ and the S&P, and there's all sorts of signs that this might be bottoming. So if you hedge 1-to-1 and the market, takes a rocket right up, which it could do when it's this close to these lows, you're going to have a possibly trapped short position to deal with, and that's going to be difficult. So what I should have done is gone, well, therefore, hedge 2-to-1, 2 parts long to 1 part short, because that way, if the market goes down, at least I'll have something that's green that I can sell. And if the market goes up, okay, I'll be incurring losses on the short side, but net, the account will be going up. So I've got 2x long to 1x short. That's what I should have done. But what I actually did was go, yeah, seems fine. I think I'll leave it. That's what I actually did, which was just, I mean, obviously, if today had ripped to the upside, then I'd go, wow, I'm a genius. But as it is, that was an error, and manageable, but it was an error. The reason I didn't hedge was simple, which is it feels to me like we're close to a local low, and trapped short positions stuck down at local lows when the market reverses up hard are really, really hard to navigate out of. But I could have solved for that with a partial hedge. That's what I should have done. Things I look at, all the things you see in the charts and we talk about. I sort of watch price action and I watch how it ebbs and flows through the day. I try and get a feel for where the power is in the market, if it's buy orders or sell. I look at option positioning a little bit, not much, but a bit. Lots of things, and just try to get a feel of where next. Obviously, that's an imperfect science, but that was the reason for my decision yesterday. Had I hedged yesterday, I'd be sitting very, very pretty, just taking short profits today. So I also find it hard to use the method, I have to say, when I'm not at the screen, because very often I've gone, right, I'm busy, hedge everything, and it's really cost me money in terms of trapped shorts in a bull market. So I have a few scars from that I don't wish to repeat. But again, the answer to that is partial hedge. So that's a long answer, but that was the basis of my decision. You see, and today is a similar thing. Should one hedge now? Well, it feels like the answer to me is no. Why? Because it could be that we're really close to a low. You've had one earnings print come in, Broadcom, that's had a beneficial effect on obviously its stock, but also the ETFs. So SMH is up a couple of points. The NASDAQ will be up a bit. Yeah, NASDAQ's up a couple of bits. And then the other thing I look at is the VIX index. Okay, now this is a measure of demand for S&P 500 puts with greater than 30 days to expiry. And look, every time it's up here, it tends to fall back. When the VIX drops, equities go up. Not linear, not perfect relationship, but pretty good relationship. And so hedging up here feels a bit, doesn't feel that wise. And this red candle here yesterday, that's the other reason I didn't put a hedge on at the end of the day, because the VIX had started to fall and it closed lower than it opened, and it closed way below where the previous day closed. That says demand for puts was falling. And when you see that happening, you can see when demand for puts falls, it really falls, and you can get a so-called volatility crush, which drives equities higher. And so I thought, well, hedging into that, no thanks. And I feel right now, I don't much feel like hedging up here, because, look, again, every time it's up here going back, more than a year, it just rolls over. Now, it could be that everything's different this time. It could be that because there's policy volatility, perhaps the VIX should just be structurally higher. But I don't think so. I think, again, there's nothing new under the sun, and I think this VIX is extended and is likely to drop. And so I don't much want to have short positions here, and that will prove wise or it won't. But that's my logic for not hedging right now.
Okay, understood. Thank you.
All right, great. Okay, let's move on. Let's do some single name stocks. Hang on. I have 2 written questions. 1 second. Hi, Matt. Yes, this is red. Yes. Okay. Yeah, I mean, teach the hedge trading. Yes. I mean, first of all, the first place to start is go to the resources menu, go to webinar recordings, and there's a webinar recording in there called Hedging 101. Watch that. And then we can do other webinars on it for sure, but start with that. And then if you have questions, ask in chat. Use the bulletin board article in the service called Request for Comments. Ask questions on this website, but start with that webinar because it covers most things in there. So start with that and then come back with questions. So again, that's resources menu, webinar recordings. Do a search term for Hedging 101. Watch that one and then come back. Okay, let's move on. Let's do some single name stocks. So let's do 2 green ones just to have some green on the screen for a little while, which is Zscaler and Veeva Systems. So okay, so now again, you can see the importance of these 200-day touches. So Zscaler on Tuesday, on Monday, hit the 200-day, dipped below it during Monday, opened below it on Tuesday, shot up, and then up again during earnings. And so this looks to me like Zscaler put in a wave too low there, which was a 61.8 retrace from the move up from the September low. So that's a righteous wave 2, and looks to me like this can keep climbing. Numbers, you saw the earnings report from Hermit. Numbers look solid, growth slowing but solid, and obviously a good earnings reaction. Cybersecurity, I have to say, I'm a little bit concerned about as a category because you've seen the federal government say, well, we're not going to do as much cyber stuff. Now, most of the cyber stuff they do is internal developer resource. There's not that much spend with people like Zscaler, but there is some. And so I'm just a little bit cautious on cybersecurity in that light. It doesn't change what corporates do, and corporates are the majority of the customer base for this stuff. But I'm just a little bit concerned about cybersecurity in that light. Let's do Veeva Systems. And my apologies, I haven't looked at this chart in quite some time. Okay, so I think you would say that's a 3. Yeah, that's a 4. Delete that. Okay, so yet again, you see the importance of the 200-day here. So this is Veeva at the June lows last year. 1 up, 2 down, almost a 78.6 retrace. Big wave 3 beyond the 2.618 extension. A wave 4 drop, and look, the wave 4 terminates just over the 200-day there. Just a little bit over the wave 1 high, and a big move up into the wave 5 high. And then that looks to me like a correction here. Looks like a 1, no, I don't think it is. No, I think you might have to view it like this. I think that's your correction. And I think that's just put in a 1, a 2, and I think that would explain that violent move up, because I think you've got a 1 up there, a 2, a deep 2, and now a 3, 4, 5 up. So I would say that started a wave 3 up. Good chance that this gap closes, perhaps it falls back to the 50-day moving average, which is around 224, before moving up. But for Viva to do this in this market environment, that's a pretty good reception to recent earnings. So that looks a really bullish setup to me. Okay, let's do some others. So let's do Broadcom
Alex,
briefly.
hi.
Yeah.
Alex,
Yeah.
can you hear me?
Yes.
Sorry. I just wanted to come back because I didn't catch it very well. On the cybersecurity side, I am long an ETF called CIBR.
Yeah.
Which actually the biggest position is Broadcom. And actually, I've been looking at it in the last days because I feel very tempted to reduce it. What did you say about the government that I missed? Did the government say something about cybersecurity?
The White House said they're winding down cyber operations against Russia. So that's I don't suppose that will be followed by corporates, but it signals that the federal government's going to spend less on cybersecurity. Now, again, if you look at where does their spend go, it's mainly internal developer resource. It's also federal defense contractors, people like SAIC, Palantir will probably do some of that as well. So they're not huge customers of your CrowdStrikes and your Zscalers and so on. And to the extent they are, it'll be somewhat internal. But it just, it's just a flag that says the sort of the notion that there's never-ending demand for this stuff, may prove not to be true. Now, again, the corporate behavior will determine the bulk of the spending in these companies. But it was just a flag to me to go, just keep an eye on this sector.
Okay. Could you take a quick look on this? It's called CIBR. It's quoted in the NASDAQ. I mean, it holds the biggest names: CrowdStrike, Palo Alto, Cloudflare, Fortinet, SentinelOne, all of them. Zscaler.
Yeah, it's in good shape, isn't it? I mean, that's a good chart, right? It's lost the 50-day. So you'd say there's downside to $60 from the current 65, and you'd say you'd want to see it hold 60, which is that 200-day. But that looks like a pretty healthy chart to me. I mean, all it's done in the recent, there's been a lot of market weakness, obviously, but all it's done is it's 72. So it's dropped 10%. That's not that bad.
Yeah.
It's held support at 65. It's the daily chart, so it's held it for a week now. The market's been pretty rough. That's not a bad chart, I would say. Yeah. I mean, so you sort of, support is close at hand on this one. So the 50 days at $66, $67. So, for it to be bullish, you want to see it get up and over that, turn that into support. And if it drops below 64 or something, then you might have downside to 60 in the first instance. But I would say that's held up better than the S&P and the NASDAQ in the last few days. So if it's strong in a weak market, that suggests it's in good shape, I would think.
Okay, that's a good piece of news.
Yeah, all right. Okay, so let's briefly do Broadcom. Here we go. Okay, so Broadcom charts, really nicely. It's institutionally owned and charts the patterns very nicely. So this is the August low, 1 up, 2 down. Again, hits the 200-day at the wave 2 low there. Moves up, wave 3 high in December, 250. Wave 4 down, hits the 200-day again. And that 200-day is just over that wave 1 high. And then looks like it started to bounce. And if that's sustained, then we're in a wave 5 up. Now, wave 5s terminate usually somewhere between the 0.5 and the 78.6 extension of the waves 1 to 3 place the wave 4 low. it can't be a wave 5 if it finishes at the 0.5 extension because it's not above the wave 3. So for this pattern to play out, and it looks like it might do, then what's going to happen? You'll get resistance somewhere in the 220s as it hits the underside of this 50-day here, and then I would be looking for a wave 5 to complete anywhere over $250, and obviously it might go a lot higher, but at $251 technically you have a complete wave 5, and one could be forgiven for selling at that point. So the chart looks good, and we'll get to the numbers later on. I'll print them later on, but the chart looks good. That's Broadcom. ASML. Okay, so no change to that. Looks like it's early in a wave 5 up. Has to get over the 50-day. 50 days currently 731, and the stock's at 719. So you want to see it get up and over the 50-day and turn that into support to be bullish on that. I would say Taiwan Semiconductor. Okay, so look. Okay, well look, here's a 1 up, a 2 down, and that's either a 3 and we're in a 4, we're about to get a 5. But look what happened here. This level here broke that wave 1 high by quite a lot. So I think it's more likely that we have a 1, 2, 3, 4, 5, and then there you go. A, B, C correction. Looks like that's come to an end. So we'll see, but maybe, just maybe, if we zoom in a bit on Taiwan Semiconductor, maybe okay, so this is the low, the recent low at 171, and it struck that on Monday. And then look what's happened since. This is a 5-minute chart, so we zoom right in here. You would say that is a wave 1 up and a 2 down. And look, it's hit its head on the 200-day. That's a purple line. Rejected it. Dropped down to between the 61.8, 78.6 retracement. So if we zoom back in again, I would say there's a possibility that this is starting a new bull phase. Why would it be doing that? Well, stocks like this do tend to run ahead of the market. They're risk canaries, where people buy them when they want to add risk early, and they sell them when they want to get out of risk. So I would say it's just possible that that's a 1 up and a 2 down in Taiwan Semiconductor, and we could start a run. That won't be a wave 5. We already had the wave 5. So if that's a 1 and a 2, let's zoom in on the hourly. Okay, so you've maybe got could hit 197 as a wave 3. Yeah, so you want to see Taiwan Semiconductor hold over 174, let's say, and if it does, you'll next see resistance, I would guess, at around 184, which is that purple 200-day, and beyond that, it can move up. So I'm cautiously bullish on Taiwan Semiconductor, to be honest. That looks like a pretty good technical setup, would be my take. Right, Google. Right, we've got 9 minutes. Let's rattle through these. Google. Yeah. Okay, so this is the COVID lows. 1 up, a 2 down, below the 61.8, 3 up. So it's got to reclaim the 200-day, which is around 177, and the stock's at 174 right now. But if it does, I would say that can keep moving up. And if you just zoom out, that's clearly a bullish chart, right? So there's a dip every now and then here in October 23, there in March 24, October, September 24, and then again February, March 25. So right now, my guess is that's just a dip on the way to bigger things. But I guess we shall see. Meta. Yeah, I stand by that chart. So here's July, August last year, 1 up, 2 down, a 3 up, 4 down, still way over this wave 1 high, breached the 50-day, and not coincidentally, the 200-day is now above the wave 1 high. So don't be surprised if that does come all the way down to 565 before it finds support. I'm not saying it will, but if it did, it would still be a bullish pattern. And then I think a wave 5 high. So I think I would be bullish on Meta, but with the rider that there could be $60 of downside before there's any upside, and there will be nothing wrong with this chart. So that would be my rider. But otherwise, looks good. Okta. Right, for disclosure, I'm short Okta. The reason I'm short Okta is just this gap up here. So I'm expecting the earnings gap to be filled at some point. I'd have just a small position. There's no comment on the numbers of the company. It's just purely a technical play. How's it looking? Okay, so here's the November 22 bear market lows. 1 up, 2 down, 61.8 retrace. I mean, it's over the 50-day and it's over the 200-day. And the 50-day just crossed up and over the 200, so you'd say that's looking pretty bullish. So my bet personally is that gap there gets filled, but it may not. So I think that overall that's not a bad setup for Okta. I'm short Okta 1 unit. If I make some money from that, good. It's not a particularly sort of big bet or a hill to die on. I just thought it could fade after the earnings print. That's Okta. Lastly, Nvidia. Okay, so it's the same chart as we saw with time and semiconductor and others, which is either we're in a wave 3 up, and this is a 1 and a 2 of 3. This is wave 1, wave 2 of this larger wave 3, and we're going to see a move up, or possibly that was no, that's not going to work. Okay, I was going to say possibly that was a 3, 4, 5, but that doesn't work. So I'm going to stick with that. So I think Nvidia can recover. The main problem I think with it is I've seen someone comment that all fund managers are in Nvidia, and so when the market is weak, people feel like they need to get out, and that causes a cascade of selling. But on the surface of it, I would say no reason Nvidia couldn't move up. Okay, we've got a few minutes left. Do we have any questions, points, comments, anything at all we want to cover before we finish up? Richard, do you want to go?
Thanks, Alex. Would you mind just going over some of the stocks that are showing as stop on Stock Central?
Yeah.
So, for example, yeah, we've got Synopsys, we've got MongoDB. I think you kind of just did a little bit on that. Intel is showing a stop. Applied Materials is showing a stop.
Yeah. Okay, so this is Synopsys. Okay, so it broke that wave 4 low. It's broken through the volume charts. So you could consider this as unsafe, I would say, down to 380, currently 445. And perhaps what we have here is, an A, B, C correction, but the one that's got some further to fall yet. So anything over 380, I would say, is potentially bullish for the stock, but yes, it's sort of catch a falling knife at the moment. Synopsys, I think today could have been yesterday, cleared some regulatory hurdles in the UK, I'm going to say, for the Ansys merger. So it looks like that merger will go ahead. They've got to do some other stuff, relinquished some business units and so forth, but so far that merger process looks like it's going to be okay. Also, look, it was only down a half point today. That's remarkable. So something good is going on with Synopsys. Yeah, that's okay. That's remarkable. So I think as regards those stop zones, they're there for a reason, which is to help avoid chasing a stock down. If it just keeps going down, helping to avoid catching a falling knife if you're buying. So I think of course one doesn't have to take any notice of them, but they're there to protect against that sort of thing. What was the other one, Richard? Sorry.
Applied Materials, very similar chart, I would say.
Okay.
Both of these were kind of local accumulation because at the time it looked like it was being accumulated, and maybe obviously, like we just said, external forces may have just thrown a spanner in the works.
I don't really know what to do with that one, because if that's not a 3 but a 5, where is the 3? Right? I mean, it could be there, but it's a shallow 3. But is that a 4? I think you could argue that's a 4. Any purist will tell you that it's broken that wave 1 high, but it's also, look, there's been a spike in volume. Pick up volume down here, which says probably that's people defending it, I would think. So I don't know. I think Applied Materials looks okay. I don't own it personally. You've got that nagging break of that wave 1 high here. But other than that, I suspect that will work out. I think that's my guess. Again, stop zones are there to stop people, or I should say, cause people to think before they just try and catch a falling knife. There's nothing wrong with if something stops out and it moves up, one can always get back in. So that's the reason for those stop zones. Okay, folks, I think we're out of time. So another good one today. Thank you. Great questions. Thank you. Anything that we didn't cover, please post them in chat later on, and I'll get to those. If you can't use, or you don't care to use Rocket Chat, then use the article that's pinned in the article list. It's called Request for Comments, and use the comments board there. We can use that as a like a bulletin board type of thing. Okay, everyone, recording live in a couple of hours. Thanks again for being members here. Talk to you all soon.